Well, good afternoon. I'm Alec Hogg. It's noon here in South Africa. Not quite noon where Martin Freeman is in New York. What time is it actually there with you, Martin?
Just gone 5 o'clock in the morning, Alec.
Oh, what a man. Up early. Are you a member of the 5 a.m. club usually?
Absolutely not.
Okay, well, nice to have you bright-eyed and bushy-tailed with us. And Justin Clarke, you are in a reasonable time zone?
Absolutely, in sunny Durban, to be quite honest, Alec.
Yeah, you're coming up to the best time of the year for the country, isn't it? I mean, those winters in Durban, wow. We should all move there during winter and then come back to the Highveld perhaps in spring again. But lovely having both of you here today. We're going to be talking about, tell me, Justin, what's the big news today?
So we've got two great reveals today, Alec. Certainly, you know, we kind of really seek out beautiful buildings, and occasionally we find one that's a plum, and that's this Princeton one that we'll talk a bit about later on. And then, of course, we're launching our fourth OrbVest diversified holdings product. The other three, obviously, very successful. You launched them, all three of them, Alec. So yeah, that's the big reveal today.
Brilliant. Well, our community is delighted as well that a lot of them got in when the rand was a lot stronger. And of course, with the stock markets being so choppy, but we'll talk about that in a moment. First, you need to do a disclaimer. Do you want to take us through this, Justin, what this means?
Yes, quite simple, Alec. And especially as we are doing a reveal, we'll be talking about product. I think we just need to inform the audience that we operate under an FSP license 50483 at the bottom of the disclaimer. And just to let everyone know that all of our forward-looking RRs, etc., are exactly that. They are forward-looking and they are forecasts. And we do our best endeavors to make sure that they are correct. But obviously, we cannot be responsible for making sure that future performance that past performance is a guarantee of future performance. Let me put it that way. Thanks, Alec.
Brilliant. Well, our general manager, Stuart Lohman, who always rides shotgun with me when we do these webinars, needs to just bring us up to date before we go into the presentation on the tech. Stuart?
Excellent, thanks, Alec. I see I'm in the back of your picture there for the first time with our new offices. Sorry, guys, just a bit of a distraction there, don't worry.
Well, we had to have a good-looking one on the screen here from BizNews at some point.
No, Alec, just the back of the head, a nice freshly haircut there. But anyway, I mean, for those new to the webinar, if you can hear my voice and see Justin, Alec, and Martin on screen with the presentation, there's a little high five button on the control panel. If you can give us a high five, just so we know it's coming through loud and clear. There we go, Alec, I've got a few coming through. That's excellent stuff. We also like to keep the presentation conversational. There is a questions option on that same control panel. If you put your questions in there, Alec can pass them on to Justin or Martin as we run through. But back to you, Alec.
Brilliant. And actually, on the dashboard that I've got on my screen, it tells me when questions are coming through. So I'll try and get to them as quickly as possible because this is an interactive webinar. The idea here is not only the reveals, but also to test the team, to give Justin and Martin the difficult questions that they can apply their minds to and make sure that everything is answered. We know the BizNews community are very enamored with the OrbVest products. We've done terribly well out of them in the recent past, and actually maybe we should start with that because with the smash that we saw on NASDAQ in just this month, Tesla was down 33% until yesterday went up 20%. Now, that's not the kind of volatility I see on the chart in front of me. Martin, do you want to just take us through this? 8% return, is that in US dollars?
That's in US dollars, paid out quarterly. It's obviously relative to every building. We like to say that the returns are anywhere from 7.5% to 8%. But you can see the relative asset classes. And the one thing that we like to consider is that we are the alternative to the volatility in the world. And so if you want the slow, consistent, steady returns, that's what we deliver. We often refer to ourselves jokingly, but in a serious manner, as the boring company, because we just deliver the same results quarter after quarter relative to each building. And certainly you can see on the screen in front of you, in terms of the listed REITs, the US sector, really just the returns in the US over the past couple of years, we really have done exceedingly well to date.
Even better than the Mafia, I see. The mob yield, 5.9.
So in terms of the medical office buildings, you do get slightly lower returns if you aggregate them all together. Some of those do come from very competitive markets in Manhattan, etc., where the very large REITs will buy these buildings and get what they consider a very steady return, but the return is at 4 or 5% per annum. So really overall in the market, number one, you've got those aggregated lower returns, and then obviously with US companies in terms of their overheads, etc., they do produce returns which are adequate by US standards, but we believe international investors have the opportunity to earn slightly higher. It's exactly the same as in South Africa, where you get the large banks and institutions that promise that you should be satisfied with 5, 6, 7% returns from them. We as OrbVest have demonstrated over many, many years now that if you run a lean machine and offer the public the investments directly, that they can achieve even better returns.
So those two abbreviations have got nothing to do with the Mafia. It means medical office buildings on the one and then cash on cash OrbVest on the other. So like a utility, however, with a better return, and it is very importantly in US dollars, Martin.
Absolutely.
I like this slide because it actually sets the scene really well.
So I think the next slide really is a summary of where we play and what we do as OrbVest. And you can see the 5 essentially segments that most people will invest into. And in terms of equities, we all understand that, and fixed income, which is on the lower end of the spectrum. But what we do is we focus on 3 distinct areas. The one is what we call the core. And the core really is a building, multi-tenanted. It is a good, stable dividends, long leases in hand. And then you move to value add, which is a building where perhaps we've got to increase the tenancy, reduce the vacancy. We've also then got to possibly remove some tenants who are non-medical and move in medical tenants, which increases the value. And so that explains those 2 segments. And then we get up to the opportunistic. That's where we find a building, you know, there's something that needs to be done. It's got a higher vacancy. It really is in a great location. Or we're about to sign the lease before we even acquire the building. And so that you've seen in the past. And so when we do acquire those buildings, also sometimes well below value, you know, that's when you generate IRRs or total returns of around 15% in US dollars. What that means is that we don't make 15% every single year in the dollars. What we do is we produce the 8% or 9% cash on cash dividends. And then when we sell the building, we produce a profit, and those 2 together give you your IRR in year 5, which then averages out over the years to around 15% on the opportunistic side. But our real business is those 2 towards the bottom, core and value add. That's what we do.
Low risk, in other words.
Yes.
Okay, and this is really important. The obvious question, people who've not invested in OrbVest before, who would be attending this webinar for the first time, would be asking, well, I've heard that property is actually bombed out pretty much all over the world. I see that the share prices of here in South Africa, a Redefine and a Growth Point, are much down on where they were in the past. So why am I even interested in looking at property in the first instance? And secondly, medical real estate itself, surely there would be differentiators between good ones and bad ones.
So just as a distinction, the first thing is in terms of real estate, there's different segments. As we know, you can get medical office buildings, you can get shopping centers, you can get hotels, etc., and apartment blocks. And we've always said that we felt the most resilient of those asset classes is medical. We proved it through the COVID pandemic. And one of those reasons is, besides the tenants who are well known and profitable, they also sign their long leases. But specifically, when you look at this graph, it is a very important determinant. And what it tells you is that people would rather go to a medical office building than, for example, a hospital. And so this graph has continued over all the years since this graph actually was published. And it's a known fact. Now think about in South Africa. Do you want to go to a beautifully furbished, a very peaceful medical office building where you've got 8 or 9 healthcare practitioners that you're familiar with? Or do you want to go to a hospital? Nowadays also what you're finding is that technology is having such a massive influence. So in the past, when you needed to have something done on your knee, you would go to a hospital. Now you go to a medical office building, you go in the morning, you have the procedure, you wait an hour, and then you leave. And so medical office buildings really have flourished, and hospitals on top of that are heavily regulated in the United States, which means anything you have done in the hospital with its regulations and compliance will generally cost you more than if you go to a private company in a medical office building. So it's been an amazing asset class that's shown huge growth and continues to.
And this is not COVID related, that gap.
No, Alec, perhaps I could add something to this graph. You know, I think that we will be presenting some detail at your fantastic conference in the Berg next week. So thank you very much for the invite there. But you know, our team spends an enormous amount of time investigating the trends, because you've got to be very careful that when you buy any building, you make sure that the exit at the end of the period, the building is going to be in substantially more demand than it is when you buy it. And there's some fascinating data that comes out of there. And you know, I think that this graph is the first thing. Not all medical real estate is equal. And that is one of the reasons why we're so hyper-focused, because if we were to be thinking about all sorts of other different asset classes, we would not be as good at selecting these buildings as we are. And I think that what's driving this, and especially in South Africa, is cost. People are concerned about the growth in the overall cost of medical care in the US. It is a major part of the economy, and it is growing regardless of what government comes in, whether it's Trump, Biden, or Obama. It doesn't make a blip on the graph. It just continues to increase. So there is a trend to push people out of the hospital system, which is generally more expensive, to these medical office buildings. And today we'll give some example of some of the procedures that are happening outside of the hospital in our expose.
But if anything, that gap now with COVID and people not wanting to go to hospitals at all would have certainly widened. But I guess we can't put everything down to COVID. So let's have a look a little bit more deeply. The next chart that you've got up there, Martin, do you want to talk to this?
Yes, so this really is a snapshot of some of the largest players in the United States and what they acquired in 2020. And you can see the kind of volume, and certainly OrbVest at the bottom. You'll see our target for this year is 150 to 200 million. Our reputation is growing literally month on month. Every single month we're being approached by new players all over the States who are wanting to now engage with us and offer us buildings. You know, most buildings in the United States are recycled every 5 years because the large REITs are acquiring them and then they're selling them just as we do after 5 years. And so when they come up, you know, you want to find a buyer who is reliable. When they commit to a deal, they're going to follow through. They're not going to let you down. And it's important for people to know that in the United States, the way things are done business-wise is I'll buy a building from someone if I was a US typical company, and a week before we close, I'll retrade you. It means that I want to renegotiate. And something that as South Africans, we don't believe in. We do business on a handshake and then into the legals. And if we commit to a price and the numbers make sense and the information is accurate, we will follow through. So our reputation is growing. You can see that we are no longer anywhere near the realms of a small player in the US even. And certainly the bigger players are aware of us and we're aware of them. And it just bodes well for our brand going forward.
Just to remind you that you can pose questions. I will not, you can put your surname in on the question, but I will not disclose your whole name. So I'll just say, for instance, the first question here is from Zippo, and I'll ask that in a moment. But the way to pose the questions is on the little control panel that you've got on your screen is a question mark. Click on that literally and just type in the question. This Zippo's question was going back a couple of slides. He said, just for clarity, the 8% dividend, is it quarterly or annually?
So that is an 8% annual. paid out quarterly. So for example, if you invested $100,000 and the building made, for example, 8%, which is $8,000, you would get $2,000 per quarter. But bearing in mind that every single building produces different returns. Some are slightly below 8 and some are above 8. Some even start below and then increase every single year, which most of our buildings do, with escalation and as we add the value to the building.
Right. So why do you do that? Why do you pay it out quarterly?
In fact, I actually wanted to pay out dividends monthly. I felt that people getting that cash flow on a monthly basis in US dollars would be amazing. But for a lot of people, they actually, we did a survey and they came back and they said, we would prefer to rather build it up and get it quarterly and then reinvest it into another deal. I really do believe that cash flow is king, and whatever somebody says on various initiatives and projects, we as OrbVest on the market are delivering yield and cash flow dividends to people. If you make a nice profit at the end, that's great, but we're in the business of you invest your money, you sleep well hopefully at night, and you get your dividends every quarter in US dollars.
We'll move on in a moment. The two questions here are very similar. Arthur and Mike from Maritzburg, my friend Mike, what are the tax implications on these quarterly dividends? And just to add to that, are the dividends and final sale profits taxed in the US?
Just over to you for structure.
Yeah, that's a very good question, Alec. So I think what's important to understand is that investing into the US is very complicated, and that's part of the reason for us being around. Getting money in and out of the US, as you know, first of all, if you're investing in a building, you have the capital gains tax to deal with, and you've also got withholding tax. And when we sort of started off and devised the system, we realized that to get in and out of the US, we would have to go via a listed entity. We use a listed entity coming out of the Seychelles. It's a merge exchange. So we actually create a listed company that owns that individual building. And that means that we are able to create a structure below that in the US that makes it extremely efficient. In fact, our tax leakage is about 1.2, 1.3%, getting that money out of the building and into the Seychelles. So to answer your question, the money is completely net. All taxes are paid up to the point of the Seychelles, but you would have to declare that if you're a South African tax resident in South Africa, and you would be taxed as a dividend on foreign earnings at roughly 20%. So that's the setup. You're earning a dividend. It's a dividends tax, and there is no other tax out of the Seychelles. If you are not from South Africa or you have offshore structures, then obviously you would have to deal with the tax in those entities. But from the Seychelles out, it's all the taxes paid.
Justin, very quick one here from Robin. She wants to know why the graphs are so out of date. 2016, 2018, not 2020.
So maybe I can just take that. So certainly we did a strategy review in 2018, going into 2019. And, you know, those graphs that you see over there are done every 2 or 3 years. And it tells a story. But that's the issue with healthcare, which I always explain to people. Healthcare is completely consistent. You know, you've got a medical ops building. It's been there for 20 years. It's going to be there hopefully for another 20 years. It's got a certain amount of tenants. There's a certain trend that happens in the US. It is so consistent. Even you look at our reports and our brochures on the rentals and per square in every building, it stays very, very consistent over all these years. So apologies for showing you graphs that are perceived to be old. A lot of our other graphs are as of 2020. However, we do like to mix them up in the webinars, so we're not showing the same graphs over and over.
Right, let's move on. And guys, just tell me when you want to move to the next slide, but this is the big reveal.
Right, I'll talk a little bit to this one, even though it's right in Martin's backyard, and in fact he's been there and I haven't, Alec. Lucky for him, but because of this strange virus, we're not getting to travel a whole hell of a lot, and at least he can drive there. So, you know, I mentioned earlier on, there are different ranges of buildings. There's the core, that are the absolutely solid, take it to the bank type of building. It actually is a category of building in the US, and this fits as closely as possible to core. So on that, remember that the circles, that's as close to fixed income as you can get. It is really an example of what a medical office block is to us. So let's move on and have a look a little bit at what this building looks like. No, go forward. Yeah, you can see there. So the light blue, core real estate. In fact, it doesn't fit into core because the real definition of core is a slightly higher, lower loan to value ratio, but not very far off. But you can see very close to fixed income.
Brilliant. Well, at least we know what we're talking about there. Princeton. Where's Princeton?
So Princeton is down.
If you go to the next slide there, I think
it's going to show. Oh my goodness. Apologies.
Not so much that one, but the following one. This one I'll just briefly touch on, and you will remember that, Alec, we've spoken a lot about the migration of people moving towards the south, and that is why we tend to invest in those states along the Smile, where there's rapid growth in population, GDP, old people. But specifically talking to New Jersey, which is coming to your question about where we are, it's to the top right-hand side of the map. And there are a couple of very interesting things happening in New Jersey. Not only is the older population growing, even though they're migrating south, they're still growing. There's also, as you know, a move out of New York in this new world post-COVID. And of course, one of the places that they move to are the suburbs like New Jersey that's got really good schooling systems, etc. Here is the answer to your question, Alec, that you have been waiting for. It's on the I-95 directly between New York and Philly. So you can see roughly where New York City is on that map to the left-hand side, if you can mouse over that. And the building is almost equidistant on that major I-95 running through to Philly. And you can see on the right-hand side the 300A building right behind 300B that we acquired in October. In fact, I think you actually helped us to launch it on BizNews. And that was listed in October last year. So we have been after this building, in fact, since we started to negotiate on 300A, and we finally got it. So owning two buildings together is very exciting. And it does mean that when you exit and you get to sell the two buildings together, there'll be a value of around $22 million lumped together. And that gets quite interesting and exciting for the REITs, and they're prepared to pay a premium to buy a campus of medical buildings. So there it is. There's your explanation on geographic location, Alec.
Brilliant. And as you said, in Martin's backyard.
So absolutely, I'll jump in.
You probably drove down
about an hour from where I live. People are not familiar with New York as much as perhaps I've now become accustomed to, and that is that people think of New York and Manhattan as this monolith of just huge concrete jungle, and it's actually not true at all. You get Manhattan itself, which is a very busy city, and in and around the whole of Manhattan, actually suburbs. When I say suburbs, it's a pity you can't see the daylight behind me, because you'll see it's completely suburban jungle almost. There's deer, there's animals, there's trees everywhere. It is a beautiful area to live in. And so you'll either move north of New York or you'll move down south to Long Island and Jersey. And that's where people essentially live. And so it is a very popular area for people to reside. It is a difficult area to get medical office buildings because there's an enormous amount of demand in these areas. We first acquired our medical office building, Medical 23, about 2 years ago. It was sold out, I think, if I'm not mistaken, in literally 7 days. And our investors there have received great dividends since then. And then obviously our next two buildings. And so it's a very popular area for OrbVest and other medical office building acquirers. And so we really are delighted to have this building over here. We've spent nearly 6 months trying to get this building under contract. And that just shows the kind of time and effort it takes to acquire these buildings.
So take us through the detail. Is this you, Martin?
Justin, over to you.
Yeah, we talked about the location on that New Jersey Turnpike, the 95. It is a great location. I mean, just to give you some insight, by 2030, the population older than 65 years old will be 20% in the state. Now, this might change to your listener that commented on data being dated. Of course, the world has changed a lot, and you are having an influx of younger people into the area. That's not necessarily a problem. In fact, it might keep some of the people over 65 in New Jersey. But 20% is a very high population. And medical is growing faster in New Jersey than it is in the States as a whole. And that is quite fascinating. It's grown, the jobs, the employment in 2020 was 16.6% compared to the average of 14% across the US. So you can see that medical is absolutely growing in the area. The biggest provider of healthcare, Hackensack University Medical Center, just spent $714 million on an extension, and that is not far from our buildings. Remember, these buildings are complementary to the hospital buildings because specialists and people provide services that I'm going to show you a little bit later on, and really want to be operating in the vicinity of the hospital, but not necessarily in the hospital campus. Again, we'll cover some of that next week, I think, Alec, but coming down to the building, 40,000 square foot, that's exactly what we look for, nothing too big and unmanageable. You can see that the returns we're talking about for the US accredited investors, in other words, the investors that come in directly to the US that still have to pay their own taxes, 12.47% RRs, and for the international investors, 11.37. We're in for $10.5 million of purchase price, and there is a net vacancy of 2.6%. I'll get to that just now. So it's almost a fully tenanted building, and we're looking for $4.3 million of equity. And I must tell you that we launched it 3 days ago, Alec, and we are already only sitting with about $600,000 of equity available on this building, predominantly because of demand from Brazil that came in with a significant amount of interest very quickly. So it's proving to be very, very popular, this particular building. We can move on.
So I think one of the things that I can mention over here, Justin, is why the medical office building specifically, and why we believe that it also aligns with lower risk. And it's because we find medical office buildings, as you can see over here, with anywhere from 6 to 12 medical practitioners. And so what that means is if something did go wrong and you lost one of your tenants who ultimately pay the rent, which produce the dividends, it's not a train smash. And so you can see here the mix of tenants. You can see the long leases going all the way up to 2030 and beyond. And that's what happens in these buildings. Think about any medical practitioner, they stay in their premises. They like to re-sign again and again and again, and they don't like to move. It's also very expensive to move medical equipment. And so this is a great diversified building of a number of medical practitioners.
Yeah, I just want to add to that, Martin. We've got 2 tenants in this building that make it so interesting, and that is they are a breast care and imaging center that has won numerous awards in the state and across the states, actually. They have very high-tech equipment that is extremely expensive to move, and they have been in the building for an extended length of period, and they occupy 26% of the building. They're a regional expert. They're not going to be going anywhere because of their equipment. We call these heavy medical because they can't move. And then you'll look at the other one, it's the plastic surgery practice, that's 26% as well, and they have their own theaters. So, it's very difficult and expensive to put in a theater into an office building, and once it's there, you're not going to move very easily. So once again, 2 anchor tenants, more than 50% of your net income is coming from these tenants that are going absolutely nowhere. They're highly successful, and they have long leases. So that complements what you were saying there, Mark. We can move on, Alec.
Are you happy here? Financial interview?
Yeah, perhaps you might want to just touch on that. I think the only real point to make here is that all of our deals, as normal, all the information is available to you on the brochure or on the property supplement or PPM, and everything is disclosed. there is a relatively small allowance for tenant installation. The reason for that is that there is, and you will notice when you get into a bit more detail, there is an 11% vacancy, real vacancy on the building, and the seller has put the value of the total rental for the 5 years in escrow to cover that particular vacancy. So if we find a tenant earlier than that, obviously then he will be able to recover that money. And the agreement is that we can take out any cost of installing that tenant out of that escrow amount. So it's almost guaranteed. Well, it is guaranteed for the full 5-year period, and that is the question that sometimes comes up around the tenant installation for that space. Martin, perhaps you'd like to lead on this on the next slide, but LTV and DCR, I think you need to talk about.
Yes, so in terms of when you acquire the building, one of the things that often comes up in our buildings is, what is the kind of gearing you use? Is it risky? You know, what are the things that can go wrong? And those are the important questions to ask. And in terms of one of the biggest things when you own real estate is there enough money in the deal so that if something does go wrong and your value drops, that you are still covered and your money's safe? So you can see over here, LTV stands for loan to value. It's the amount of money you put in relative. So we put in $4 million and then we get a $6 million mortgage. Before we get to the question which we always get asked, the mortgages are fixed. If interest rates go up, it does not affect us. Our rates can come down, but we'll always fix and pay a little bit extra to make sure that they are fixed. And those mortgages are generally 25, 30-year amortizing mortgages, which we agree to then settle and pay off within, call it 7 years. And so it is a very successful model in the US of being able to use equity and debt to be able to get strong returns. You can see over here a typical building where we're raising $4.5 million, of which, as Justin mentioned, we launched it literally in the last couple of days. I think we've got $600,000 odd left. It's been incredibly popular. I don't foresee anything other than us being oversubscribed by this weekend or certainly into early next week. What that means also is when you go onto our platform, when you still see it, sometimes we also get questions as you're saying it's oversubscribed, but it's still on the platform. And that's because as the last few people are moving their money in, they've got a certain reasonable amount of time to move it in. And if they don't move it in, whoever's on the waiting list then takes that slot. And so that pretty much discloses everything. Justin also mentioned transparency. Very important. When you invest into our products, every single thing is disclosed upfront. You'll see what we make. You'll see what the fees are. You'll see what the building projections are. And that's the beauty of real estate. You get into it seamlessly in the US. You get out of it seamlessly. Everything's disclosed. There are no hidden costs, no surprises along the way. And that's one of the things we're very proud of.
So $600,000, give or take, is probably around just under 10 million Rand. What is the minimum investment? In other words, someone looks at this and says, the Brazilians have taken the lion's share, but there is still a bit left. What is the minimum amount that an investor can put in to have a slice?
Justin?
Yeah, Alec, absolutely. You know, I think that we have made the minimum investment very low, considering that we like people to get in and taste what we have to offer. So it's $5,000 to be quite simple. So it's absolutely an opportunity to get in, see what a really, really perfect medical office building looks like, and you know, feel us out and get that done. So that's it.
And I would like to add just one more point is that, you know, we talk about the product for South Africans. You know, OrbVest continues to grow globally. We are now firmly also in the US, Alec, which I'm not sure if you know. We launched in the US successfully. And so what's happening is all the countries around the world, when we get a property, immediately get a taste of it and they start investing into it. We will always make sure there is spaces set aside for our valued partners and channels in South Africa and our customers in South Africa. It's part of our business philosophy. We're not going to ever change that. And so you can understand that when every country is putting in a couple of $100,000 now, it gets snapped up very, very quickly.
And there on the project parameters is the $5,000. All I had to do was just refer you to that one. Shall we move on to the next, the fund of funds? Some people would recognize it as from the unit trust or ETF industry. It's something similar.
Absolutely, and I'm gonna, you always got to judge, Alec, where people put their own money, and I noticed that Martin is putting all his family into these ODH products because he likes them so much. So I think we should let him talk a little bit about it. But first of all, if I can tell you how we got into these, just to remind the audience, as we got to build up relationships with the financial advisors, people that are looking after other people's money, we discovered that they were taking money from people's pension funds and putting them directly into a building, and those clients wanted to live off the dividends. Now, that's all very well, but what happens if something goes wrong? Let's face it, with any commercial building, a tenant can abscond, a flood can happen, a fire can happen, and we've had that. But let's face it, that would be a problem if you've got a tenant that's living off those dividends to pay for their lights and water. So we quickly cobbled together the ODH1, which was a little bit of each individual building that we had left over or lying around, or that was in our own investment, or that we could buy back from other cornerstone investors. And we shoved that thing together. And as you know, it was surprisingly well taken down. And I think we've slowly grown and matured the product. And this one, ODH4, we are, although we might have dropped the minimum return to 7.5%, remember that all the underlying buildings are the same. So it's not necessarily different from any of the other ODHs in terms of the return. We're just saying, to meet your expectations, understand that 7.5 is probably a more realistic number if you want to live off the dividend to be able to budget for. So that's it, Mark. Tell us a little bit more about your favorite product.
Yeah, so Alec, as time has evolved, OrbVest has got to understand the requirements of customers around the world. And one of the things that certainly, whether it's a pensioner or whether it's a large institutional family office, they've asked us for is, we love individual buildings and they give great returns, but sometimes we just want to give you the money and just know that it's safe and that it's diversified and it's low risk. And so hence that's where ODH came from. It is taking a low risk investment and spreading it across 8 minimum low risk investments. So for a little as $5,000 up to even $1 million, you're getting your money into ODH. ODH then goes and buys a piece of each building, just like you would, or I would, or my family would. So in a 4.5 million, for example, Princeton building, ODH will take a piece of that, a couple $100,000. And so when the dividends are paid out from the Princeton building, just like everyone else gets their dividends, so does ODH. And so this product certainly is proving to be immensely popular with everyone. And one of the keys to investing for all your listeners, if you listen to any of the top experts in the world, and it's not from me, from them, is diversify, diversify, diversify. Spread your money across a lot of investments. And so this certainly helps when, for a small amount of money, you're again spreading your money across different buildings in different states, all producing good dividends, which means that the chances of something going wrong are a lot lower than even in a direct building.
It also plays to the trend towards fractional investing. We're seeing that this is really sweeping the world. Here in South Africa, on the equity market, for instance, you've got fractional investing through easy equities. So you can go and buy 100 rands worth of Amazon shares, which ordinarily would cost you 50,000 plus to buy one single share. And the $5,000 across many different buildings gives you something similar.
Well, and I want to comment on that. We've had a few customers approach us in the past week and they were astounded. They literally phoned us in the morning, were registered by lunchtime, got a document to us 1 or 2 days later, and they were into medical real estate in the United States literally in 72 hours. I mean, it is as quick as that. And so if somebody had to go and invest into 7 or 8 buildings with us, they would need $40,000, $50,000. And a lot of our customers have got that. But there's also the other side of it that says, even if you've got $50,000, we would recommend to our customers, put 10,000 into ODH, 10,000 into Princeton, 10,000 into our next couple of buildings, or even put it into equities, but spread your money around. And that just is very good sound advice, I think, for anyone from my perspective.
And ODH stands for OrbVest Diversified Holdings. Number 4, how many individual buildings do you have now? Last we spoke, I think it was OrbVest 30.
So this is number 30 in terms of Princeton. And Justin?
Yeah, sorry, perhaps you can just move on to the next slide, because I think that the big question that everyone asks is, what goes into these buildings? We have certainly used up any equity that we have available in the early buildings, but the ones 30, 31, and the ones that are already, if I can say, under contract, but that doesn't necessarily mean that they're under PSA or property sale agreement, are the ones that we can't talk too much about, and those are 32, 33, 34. And then the other ones that are in yellow are buildings in the future. So just so that everyone understands, as we raise for this particular product, if there is surplus funds that we haven't deployed into those buildings, then we will use it as a mezz debt, which we pay 10% into the OrbVest diversified holdings. So that's how we can absolutely underpin the 8% growth. But to answer your question, Alec, you can see that we recently have fully subscribed 30. It's still got a list. 29 fully subscribed. Again, it should be listing any day now. And so now we're on to 31 to 34. And there's some great buildings coming up there. So I'm sure hopefully you'll have us online to share those as they come up.
We will, but we're going to ask you to switch off your notifications in future because they seem to be coming through on your computer there, Justin. You're a popular guy. So this Princeton is medical 31. When you talk there at 35, 36, 37, 38, and I think anybody watching this is going to say, hang on, there's 34. That's looking at a 9% yield as against in the 8s for the others. Shouldn't I just hang on for that one?
So the answer to this is that OrbVest diversified holdings, all the money received other than really a nominal, and I'm talking a nominal, I think it's 0.3 or 0.5% that OrbVest charges to manage it, all the money goes to the investors. So whether there was a building there that did 8, 9 or 10%, it still goes to the investors. We just like to always believe in the mantra of under promise and over deliver. So when we say the 7.5, certainly from my perspective, I would hope we're doing above 7.5 and above 11% IRRs. But the point is that in the buildings going forward, because we also haven't finalized them, and I will give a sneak peek, one of the buildings we know we've just actually put under contract. It's a possible dental practice. It's got a 9-year lease. The other building is in Florida. I'm not going to mention more than that, but we've got a lot of buildings in the pipeline. And as they're coming up, we've got a very good indication of more or less where they'll be and what the prices are. And as our network of partners is expanding across America, we are very comfortable, as we said, that we will be doing a deal almost every month or second month, certainly going forward. And so this ODH product will be filled very easily. And also, let's not forget that if any person in any one of our buildings is selling their shares because they need to for personal circumstances or they're immigrating, in the past, that used to be purchased between buyers and sellers in the deal. What happens now is OrbVest actually buys it into our ODH because obviously whoever buys it along the path towards the exit gets a great return.
Okay, so just to understand this, I put my $5,000 into ODH4. It's going to be spread amongst these buildings all the way down to medical 38.
Yes. Even
though you haven't got the buildings yet, so it's kept on hold as part of the equity of that building. I think that's pretty clear. Just to remind you, we've got quite a few questions here, guys, and I'd like to get to them in a moment. But to remind you that if you'd like to pose a question to Justin and Martin, just click on the little button which has got a question mark on it and type it in. I'm only going to give your first name, so don't worry about anonymity. That is guaranteed unless someone knows your voice, or they wouldn't even know your voice, knows the way you type. Okay, moving on to the next projected parameters.
I'll talk through this very quickly. You can see over here, if somebody had to invest $10,000, what their returns would be on a projected basis per annum. And then at the very end, there is a capital gain, and that gives you an overall return of, for example, 11.39%. I would like to draw the attention to the fees that we charge on this product, which is exceptionally low, which is 0.3% per annum, which really, in context, to earn $12,000, $1,000 a month to manage this whole product, it really is enormous value. And we believe that we make money in the underlying assets. So therefore, this is really a product that we facilitate for our investors around the world. The other thing is that we make 0.5% only when we achieve 11% plus in terms of the IRR. So pretty much every single thing goes to the investors. What you will notice in year 2 and year 4 is we sometimes get asked the question, what happens if your underlying buildings, one of them sells sooner? Well, when you sell a building sooner, you want to take all the returns if possible and return it to everyone, because that increases your overall return IRR. What we've decided to do is we will either return all of it, or we will hold a minimum of 50% of the money, meaning let's assume that it produced $100,000, we'd pay out $50,000 to the investors. The $50,000 stays in the bank account to make sure we sustain the dividends per year and possibly higher dividends. But by year 5, everything gets paid out to the investors. We don't hold back or take anything. And in fact, if we don't need the 100,000, it all gets paid out to investors straight away. That gives you an overview of how the product actually works.
And the reason for this is that you invest alongside the other investors.
Absolutely.
Okay, I'm going to get to the questions now, guys. Thanks. That was a really good summary and a good wrap up. Here's Mathavan. I probably haven't pronounced it correctly, but I've just done something real silly there. My apologies. Mathavan, will you mind reposing that question? I somehow just managed to delete it. I apologize. Haroon's question here is, do you have a projected income statement?
So we do have projections. We also have a property supplement that is published on the Merge Exchange. Everything that somebody requires, when you get hold of our client service individuals in our business, we will forward all the necessary information to you.
Haroon's got a follow-up. He says, please explain the carryover split where the investor gets 65%.
So what happens is that, Justy, I'll take this one. OrbVest essentially makes a profit together with the investors on every building. And so what happens on the free carry is when you get to the very end, we're aligned with the investors. That's where we make the bulk of our revenue as OrbVest. And so what happens is at the end, when the building is sold, you've paid all the legal expenses, the transfer fees, etc. There is a net amount. That is generally split in all different segments around the world between the investors, the GP, the general partner, other co-sponsors, etc. And so in this scenario over here, you would have a 65-35, which is then split 65% to the investors, and the 35 is split 17.5 each in the Princeton building. What this means is that in ODH, you simply are investing into Princeton. That 65% portion that comes back and then goes directly to the investors. I hope I've answered it, and that's what Haroon was alluding to.
Mathavan has actually reposed this question. Thank you, and sorry for my fat fingers. When dividends are paid from the US to the Seychelles account, is it taxed or are they taxed? Thus, by the time we receive the dividends, they've already been taxed in the US. Is there a double taxation agreement between the US and the Seychelles?
No, I think the best way to answer that question is that the return that we are talking about into the Seychelles, all the taxes have been paid to that point. And as I say, the leakage is incredibly efficient. We lose, 1.3% in resolving all those tax issues in and out of the US. And Haroon, we've been doing this for a couple of years, so this is a well-oiled machine. Remember, again, one of the benefits of using the islands is, of course, there is very low taxes, no capital gain tax, and certainly no withholding tax. So whatever you do with your money once it's in the Seychelles is your own affair. And I think that your only responsibility is to pay your dividends tax in South Africa from the Seychelles. So to answer your question, there is no tax due on the money sitting in the Seychelles.
Thanks, Justin. Brian's question is, when can one expect to receive the first dividend payment if investing now in ODH4?
That is a very good question, Brian, and I think that people do need to understand that when you invest your money, what we do is every 2 weeks, we move that money into the project, and you will start earning interest at 7% for the first 6 months. It might be less than 6 months, but we're saying 6 months. At that point, the ODH4 would be listed on the exchange, and then we would be able to pay you a dividend. So to answer your question, to be very clear, after 2 weeks, your investment will start earning interest. It will not list before the end of Q1, so therefore you won't earn a dividend until the end of Q2, and only then would a dividend kick in, and it will include the roll-up of all the interest that's earned up to date. I hope I answered that question, Brian.
Charles, your question somehow hasn't come through. All I can see on the screen is ODH. If you wouldn't mind just repeating it. Jackie says, is the projected 7.5% before OrbVest fees or after?
I can tell you that all of our fees are built into the project. Martin, sorry, I beat you to it there. So it is absolutely net. If you put in $100,000, you get out $100,000 plus your return of 7.5% or whatever it is, plus your IRR at the end of the project.
I just want to expand on that for a second. So we get this question a lot. What you see as the investor is what you're going to see after we've bought the building, we've added on tenant installation, we've added on the obvious due diligence fees, the legal fees, closing fees, our management fees, all the way down. It's a waterfall that goes right through to the bottom to what the investor gets. So when we show you that, it already includes everything. And that's very important to understand because there are no hidden surprises or costs or anything else. And in terms of what Haroon asked earlier, remember every single building, it starts at the very beginning. And I will give you an analogy of if you bought a building in Johannesburg, you would have 10 tenants. It starts off with every one of them, who they are, the credit vetting of them, their leases, the escalations every single month for the next 5-10 years. And then thereafterwards, once you've got your gross income, you've got your expenses, your property taxes, your insurance, all the way through to the bottom. And that then produces a dividend which gets paid out to everybody who invested in that building. And then that then goes through to the investors. All that happens is that if you think about it like this, ODH is one of those investors alongside any other investor.
Just to remind you that you can pose your questions. We're coming to the end of the webinar now. So if you've got a burning question, please put it up there. We don't want to have anyone leaving disappointed. Bruce's question here is, do you have a leasing schedule?
Without a doubt. So certainly in terms of when you acquire the building, there's two components. The first component is what leases do you have in place and the tenants? What renewals do you have? What escalations do you have? All the buildings in the US that we acquire have between 2 to 3% escalation built into them. There is a perception in the US that you've heard me say before, there's no inflation. That couldn't be further from the truth. There's absolutely inflation. And then besides that, there's a lease up schedule. The lease up schedule means before we acquire the building, we will have in-depth discussions with all the management people in the area, the leasing agents, and we will have a very good idea as to how we are going to lease up the remaining vacant space, at what kind of per square foot. Is it going to be below market so that we can fill the building very quickly? And are there potential individuals or medical practitioners who want to move in straight away? And so this lease up schedule is built into the projections, and that then produces a tenant installation allowance per building based on when we think they're going to come in. So absolutely, every single thing is a complete game plan up front. By the way, it's not Justin and I who decide on the buildings. We have input into them. We have a very distinguished independent investment committee made up of well-known individuals in South Africa and elsewhere that have been in real estate for 30 years. They have complete veto over any building. If they don't like the building and it doesn't meet the requirements that they believe is an appropriate low-risk investment, they will simply not go forward with it. So that's the process. It's the investment committee that looks at it, gets the building provisionally approved. The team then moves in and starts negotiating and doing due diligences. And then it goes back to the investment committee multiple times before it's actually then signed off and we then go into acquiring the actual asset.
Is that where Henny Bezuidenhout's role comes in?
Absolutely. Henny is the chairman of the investment committee, together with other well-known individuals like David Vandrach and Alan and other individuals who really themselves have been involved in real estate for over 30 years. They are intimately knowledgeable on any kind of aspect on real estate, and that's where we rely very heavily on their experience to make sure that we're acquiring the appropriate assets.
Charles' question I can now see. On ODH, he says, dividends are also paid out quarterly. It can be reinvested into ODH, just like a fund, or is there a cap? Thank you.
You can't reinvest into ODH4 because by the time we get to, for example, I would assume the next 6-8 weeks, ODH4 will be closed. So a typical fund is what's known as an open-ended fund and a closed-ended fund. What you would know as an open-ended fund means you invest your money, it's completely liquid, you can buy and sell anytime or shares in that company, and they also roll it just forever and ever, and it produces profits every year. Our funds are closed funds. It means everything is upfront, disclosed, transparent. You invest, we're going to invest into 8 different buildings, we're going to hold it for 5 years. At the end of it, we sell everything, it's shut down. And so what you can do with your dividends is when you get your dividends after the first quarter, I'm reasonably comfortable there will be another good building or an ODH, potentially 5. You can invest it into the next project.
A quick follow-up there from Lawrence. He says, why the 4 in the name?
Mark, you're on a roll there, so I'm letting you go with it. But yeah, as I mentioned earlier on, Alec, we tentatively launched ODH1 at the beginning of last year. It was very popular. We kind of did a few iterations of it, 2 and 3, and we closed 3 recently, and now, of course, we're on to 4. So the number 4 means that it's the 4th version of the 4th ODH, and we have listed 3 already.
Justin, while you are there, there's maybe the last question, because we literally ran out of time now, from Peter. He says, I'm a bit concerned about the slow rollout on medical 29 and 30. So those would be buildings 29 and 30, not the Princeton one, which is 31, which were my first investments with you. A bit nervous about this going forward. Can you give us some background?
Yeah, absolutely. I think that it does take some period to get the senior debt negotiated, and there has been some delays on 29 and 30. I think the 29 project we have managed to improve. So the good news for you is that it's a better project in the final days of the negotiation on the senior debt. And as I say, 30, again, some delays on the senior debt, but it shouldn't affect the net returns to you. And we hope to have that listed in the near future. But certainly on 29, we have the benefits are that it is an improved deal subsequent as a result of the delay.
I can maybe jump in there and give a little bit of context, because I was party to it during the final days of December, where America doesn't shut down like South Africa does. And so it got to the final end part of December, and there was a negotiation with the seller where we got a very nice reduction, which consequently will increase the returns to all our investors. And so that's what delayed part of that. We haven't actually shown everyone it and publicly gone out and stated it yet. We will be doing that in the next little while, but I can assure that investor that they are certainly into one of our better returning deals at this stage right now.
So Peter doesn't have to be
Martin,
too nervous then about that.
Yeah, I think actually this is you need to share the detail of it, because it absolutely shows, in investing in real estate, it's more about the team, Alec, as you can understand, because problems always come up. And when a problem comes up, it's how you resolve the problems. And this is what we're kind of most excited about. We almost like a problem to come up because we can solve it. Mark, give us the numbers there, because we managed to get $1 million discount off that selling price of that building at the 11th hour because they wanted to close in December. And we managed to switch around. We got expensive seller finance in order to do the early close to get the $1 million discount. But prior to listing, we have now gone out and got senior debt to then be able to pay back the seller finance in order to improve the return for the investors. And we brought the 5-year period to 3 years, which of course pushes the IRR up. Maybe you want to share a bit of that because it is on the public domain.
Well, I think, Justin, you summarized it perfectly. What we like to do is we like to go in with a plan. And if we can ever improve on that, it's not that common that you get everything coming together in the couple of months straight after you bought it. Medical real estate takes time, and it's a 5-year plan. So we really are super excited on Medical 29. It's a pity that I didn't put more people I know into Medical 29. It got snapped up very quickly. But we're certainly excited about the projections on Medical 29. And that's also another reason why, if you think about Arizona at the moment is such a buoyant market, such a competitive market. And that's where both Medical 29 and Medical 30 are. So we're excited about that market. We've discussed it in the past. Hopefully we can find another 1 or 2 buildings in Arizona this year or Florida. But the market is competitive there. And so those are our 2 assets. And so we're very proud of it in summary, and I think they'll do very well.
Well, thanks for the discussion today. As always, lovely talking with you, Martin. We can see the sun has now risen in New York, so lovely trees in the background. I get what you were saying earlier. It's not a concrete jungle. Justin, look forward to seeing you in the Drakensberg next week at our investment conference. It's really going to be a blast. There is a final question here, which is actually directed at me. It's from Gareth, and he says, are you an investor in OrbVest? And all I can say, Gareth, is not yet, and not despite my wife's best efforts. She's trying to get us to invest in OrbVest. Unfortunately, we have this monster when it comes to requiring capital called BizNews. So I'm investing in my own business, and until such time as the allocations of capital can be put into utility type investments like this in hard currencies. But would I invest in OrbVest? Most definitely. So there's no question. OrbVest is a partner of ours. They've been a business partner for a couple of years. We've had literally hundreds and hundreds of BizNews community members who have participated. And I haven't had one person, guys, I can tell you this honestly, not one person who's come back to me to complain, to say that you haven't delivered what you promised, or that you watch out for these OrbVest guys, or they are snake oil salesmen, or whatever else you want to call it. So thanks for doing our community pride. Thanks for being our business partners, and thanks for bringing another new investment opportunity to us. The idea of OrbVest, the longer term idea of OrbVest is that, and they can't really tell you this, so I'll tell you, it's that these entrepreneurs, these two, plus Henny Besaidnout, who I mentioned earlier, they were investing themselves in medical properties in the United States. Martin moved there. He's the chief executive of the company to be hands-on. Their money is in OrbVest, and they are wanting to list it on NASDAQ when it gets to $1 billion company. And the way they're going, it's not going to be in the too distant future. So that's the story. That's why we're very happy to have them as business partners. And well, one day down the track, I certainly will be investing alongside. Thanks again, guys. It's been a terrific information session, as they always are. And we look forward to the next time.
Thank you, Alec.
Thank you, Alec. Thank you, everybody.